And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow. Hello, everyone. Welcome to this week's Wealth Within Update. I am Jim Beach of School for Startups Radio, and always joined by Dale Gillham of wealthwithin.us. Dale, how you doing this week? How is the lockdown?
It's super fantastic. It's always interesting being in lockdown, and my wife knows where I am all the time, but it was interesting. The other day I was on a Zoom chat, and behind me I had some kangaroos on the back lawn, and it was an international Zoom chat, and they were more interested in the kangaroos than they were of me. So go figure. But hey, we've got to put up with it, don't we? But our numbers are coming down and it's looking better, but hopefully things are looking better in the US.
No, not at all. We are facing imminent total destruction at any possible second. So just check the news. That's all you have to do. All of us will be dead within minutes if they had their way. So, it just feels, I don't know how you can watch the news here now, because it's just so bad and so depressing, and good things are happening all around. The kids are going back to school virtually. That's better than not being in school virtually. So at least we have some progress, and, I don't know. We're just hoping to get through the election without destroying our country in the meantime.
Yeah, who needs a nuclear war when you got a COVID-19 situation and riots and everything else? So
that's right.
We feel for you.
But who doesn't feel? It's the marketplace going up again, despite everyone in America having a pretty pessimistic week and negative sentiment as high as it's ever been. But the market just continues to go up. I saw something interesting that at the beginning of all of this, some of the price to earnings ratio was averaging around 15%, and now it's up to 25% average. And the only thing that's happened in that time is the worst news of all time. Makes no sense. Your thoughts?
Yeah. No, look, it's seriously doesn't make a lot of sense to me either. But that's when you get in these sorts of bubbles, and it's really sort of caught a lot of us by surprise, where the amateur or retail investors are doing really, really well because the experts are staying out, and the retail investors are out there playing and in essence getting their timing right. They're actually buying stocks, taking the market higher. We've talked about the Robin Hood traders, those sorts of people, because they got nothing else to do. They're at home, they're not working, or they're in lockdowns, all sorts of things happening. So they're trying to make money out of the market. So you understand that, but eventually they'll run out of money because they're not buying on common sense or good fundamentals or good metrics. They're actually just buying because they see something moving, or they've been on some sort of a chat, or the app that they've got on the phone says to buy Tesla or whatever the stock is. And so that's what we're actually seeing. I mean, the Dow Jones was up 1.81% last week, and for the second week in a row it was stronger than both the S&P and the NASDAQ Composite. And I think the S&P was up about 0.64% and the NASDAQ Comp was up 0.8%. So they barely moved, those two sectors. But again, this really does beg the question whether the smart money is now moving out of that technology into more defensive stocks into the Dow, and we have to think that that's becoming a reality. Generally, you'll see the smart money go into the bigger, more defensive stocks at the end of runs. But right now, I think we could still see the market move up for another maybe 2 to 4 weeks, but I don't think it's going to be longer than 4 weeks, because this sort of move will capitulate eventually. The sooner it capitulates, the better, but I'm saying maybe 2 to 4 weeks up at this point in time.
So I saw my first Robin Hood ad on television, Dale, and the most interesting thing about it was the channel that it was on. It was not on MSNBC or the business channel. It was on one of the cooking channels. A cooking channel advertising Robin. I think that's very indicative of where we are. They think their marketplace is on the cooking channel. It probably is, the cooking channel, guys getting ready for their dates to come over and they're cooking something up real fast. Hey, I might as well invest before my date as well. And if they're advertising on the cooking channel, this is certainly one of the signs of the apocalypse, isn't it?
Yeah, look, I thought you were going to say the Disney Channel or something.
That would be
like
even
that.
worse.
But it is. You do see a lot of. I mean, we're seeing ads in Australia from some of these places to entice people to trade. There are a few of them coming out there. They come out of the woodwork when it's a bit easier to entice people. Fear is one of the biggest motivators, completely, and right now people are quite fearful of their security, and you only have to look at Maslow's hierarchy of needs. The bottom one is basically security, or the bottom two are basically about security. So having a roof over your head and having money so you can eat, that sort of thing. And so people have been challenged by that. And so it's not surprising to see ads that will say to people, hey, look, make a lot of money, just grab this little app, plunk a couple of things in and you're off and you're making a hell of a lot of money. And they're reaping the benefits while they can. That's smart business. But, is it long-term gains? And from history, I've been through a lot of these boom-bust type of cycles, and at the end of the day, there's blood on the streets. The biggest thing that I don't like about these Robinhood apps is whilst they don't necessarily push heavily the lending side of things, people to borrow to invest, they are pushing that. But you're getting people with no knowledge on the market using credit cards, borrowing all the money they can, et cetera, and it just snowballs and snowballs until eventually the bubble bursts and they're left holding the bag with lots of debt. So, but that will happen. It will happen. There's no doubt on my mind. It's just when right now, and right now the market is moving up. So, we're seeing some of these top 100 stocks moving up. Cisco was up over 10%. Salesforce and PayPal, they were down 3%. Well, Facebook and Netflix were down over 2% last week. So you're getting this mixture in the marketplace. Property group, Simon's Property Groups was up over 9%. But Qualcomm's
that makes no sense whatsoever. There's no reason. The only thing that I heard last week was that, and this is a negative, that that Amazon was considering renting mall space from Simon and other mall vendors to put in fulfillment centers. And taking a Class A real estate and turning it into a warehouse distribution center is not progress in the world.
Nope.
That's not a 9% gain.
No, I can't figure that one out. Qualcomm was up 5%. I understand that one. Boeing, Nike, and TJX, they were up over 4%. Boeing is still a bit of a basket case, isn't it? But Nike's doing okay. TJX in retail, they're doing okay. But then you've got Dow DuPont, Chevron, and GE. It was all, they were all up around 4% as well. So it's real mixture right across the market. And reporting season wasn't as bad as I expected, and many experts expected. So it's all pretty much steady as you go, but it's all over the place. And that's the thing that really does concern experts like myself, is it's not like a normal bullish run that you would actually see, a more broader bullish run. This is segmented. There are stocks taking off and others doing the opposite. So that's why, I think why the Dow's moved up in terms of if there is a flight, the smart money's going for good stocks, for good defensive stocks, where I won't call it the dumb money, but the uneducated money is still trading anything that's moving and hopefully making big gains. They're probably jumping on anything to do with, people finding a vaccine for COVID. They're speculating on the market all over the place. You can see it everywhere. And eventually it's going to, as I said, burst, and there will be blood on the streets.
Dale, let's move on to a different topic. One of the things we wanted to discuss today was the differences between rich people and broke people in terms of their financial habits, their spending habits. Let's go through some of these. Some of these are kind of fun.
Yeah, I thought these were sort of a bit relevant at the moment because there's a lot of people making a lot of mistakes and they shouldn't be, because it's quite simple. And rich people don't make these mistakes. And the first one I've got is people that are broke don't plan for a rainy day, but rather they spend most, if not all, of their money. That's what they do. And we see a lot of people run out of money before they run out of week. And that's the statistics that we're seeing right across the world, not just in the US. The second one is, they take their money and investing advice from friends. Remember, and I always quote that, remember, birds of a feather flock together. And, why would you get your investing advice from a friend who's just as broke as what you are? It just doesn't really make sense. And so rich people or wealthy people don't do that. They get good consultants to people or good experts around them. But, worse is these people get tips from unknown people in forums and social media. I mean, they just, like the Robinhood traders were mentioning, they have these apps, and it's just, there's this big chat that they're running around, and they're all talking about all the same stocks and ramping the same stocks. But really, those people are just as poor as what you are if you're taking those sorts of tips. The next one is they spend too much of their money buying what they want rather than what they actually need. And this is a real interesting one. I know, my wife said to me one day, I want to buy this. And I said, so do you want it or do you actually need it? She goes, I want it. And I said, well, you can't have it, because you don't need it. And that's what we call about extravagant type of spending. It's those impulse spending type of things is, oh, I like this jumper because it's red, I'll buy that. Do you actually need it? And rich people tend not to do those sorts of things. They're a lot more astute with their money, going, well, if I buy it and it's sitting in a cupboard, then why did I do that? I may as well put it into a stock or invest it some other way. But as I said, so it's always about, do you actually need it or do you just want it? The next one is about monthly subscriptions, and I know everybody's getting pushed to get monthly subscriptions, whether it's Netflix or whether it's, Apple TV or whatever it is, gym, streaming services, all sorts of stuff. And we're getting this pile of these streaming, all these different monthly subscriptions. I mean, I was looking at, I play a bit of guitar, and I was looking at a thing advertising me to join up, and it was like, $20 a month just, for me to play the guitar. Then it's like so much a month for my Netflix, so much. And I'm cancelling all my all these different streaming services and all the different monthly fees, because you can save a lot of money doing that. But a lot of people have ones they're not even using or using very sparingly. The other one is they don't pay off their credit card each month. And what happens is you end up paying high interest rates, up around, some of them are 20-25% interest rates. And what that means is you're paying a hell of a lot of interest, or way too much interest, every single month, and you're actually behind the eight ball there. You're scrambling all the time to keep paying back, and the credit card companies know that most people never ever pay their credit card off. That's why they're making lots of money. But interesting thing is that people they actually like having cash in the bank, earning almost nothing, rather than pay off their credit card. If you've got cash in the bank, just pay it off your credit card as much as you can, because you'll be far, far, far better off. And the other one, the next one I've got is that they indulge in creating bad debt, such as buying cars. And I even put a house in that as bad debt. And to me, bad debt is something that costs you an interest for lifestyle choices. So whether it's a car, whether it's a house, whether it's going on a holiday, all of those sorts of things, anything you borrow money for that is a depreciating thing, or you just spend it and you're on holidays for 4 weeks and then it's over and you've got to pay out money back. That's all bad debt to me. And I haven't put a family home in that. Unless you can claim it on tax and depreciate it, etc., it's a bad debt to me. And so people love creating all this bad debt and chaining themselves to this big boat anchor that I call the banks, and they're quite happy for you to pay lots of interest to them. But rich people don't do that. When I'm out there spending, I don't spend unless I've got the money in the bank to pay for it. And I use the banks to help me get things and pay it off pretty quickly. Like you get those interest-free periods for 90 days or a year or 18 months. I'll use that and then just pay it off at the end and don't pay any interest. So these are the sort of things that rich people do. But that's just a few of them.
All right, I want to go back and talk about some of these. What about using a debit card for 100% consumed expenses? For example, going to dinner. I hate seeing a credit card debt for my dinner bill that I ate 3 weeks ago. So I actually put that on a debit card so that it's paid for. I also use debit cards, Dale, for my subscriptions, because every year I get a new debit card automatically from my bank, and I love it because it automatically cancels out all my subscriptions for the year, and I have to start over from blank. And so I like that. I'd love to have you talk about that, number one. And number two, I'm just going to disagree on the home as a negative debt. My home is appreciating pretty quickly. It might be my most rapidly growing asset right now. I'll tell you this, we've been in our house for 5 years. We paid $365 for it. A house around the street around the corner sold for $565 this last week. I think my house has appreciated some $200,000 in the last 5 years. And I think that would be a positive. And so number one and number two, please. Credit card. Debit card number one.
Debit cards, I like those because you're actually spending the money that's in the bank. So you actually really got the money. So I 100% agree with you. People should be using debit cards. And you do have Visa debit cards where, they're just paying it off, and they're quite low fees on those. So I 100% agree with you on those. I love it. I love that it cancels all the subscriptions every single year, because that means you're getting cleaned up every single year, which is great.
It's so easy. It's so easy.
It is very, very easy, because it's easy. When you've got plastic, it's so easy to spend. You see something and just tap and go. And and I know we chatted about it quite a while back, whereas, when I was young, when I first started working, I got paid in cash. Once the cash was gone, I couldn't spend. Simple. Whereas nowadays, what we're seeing is these buy now, pay later ones where people are spending next week's paycheck, and I'm really against that sort of stuff. But, it's out there, and that's the banks are trying to keep you broke, basically, because you just keep paying more and more interest. Interesting thing is a lot of people have your view on property, and I understand the view because I bought it at this, now worth this. But right now we're in a low interest rate environment, very, very low. I think it's the lowest interest rate environment in the US. But generally with normal interest rates, if you look at a normal loan on a property over, say, 30 years, if you add up all the interest you've paid on that property and you add up all the maintenance and all the other costs associated with that property over the 30-year period, what you've gained in appreciation in capital gain on that property, you've actually spent in interest and in maintaining the property. You actually haven't got anywhere. So that's normal. And I've done that research numerous times. Whereas here in Australia,
a rich person would never have a 30-year mortgage. So we're going to go with the 15-year mortgage.
Yep.
Let's assume that.
Yeah, well, rich people, they do something a little bit different. They have different structural setups, such as companies, trust structures, those sorts of things, and they tend to own the properties in that, and then they rent off themselves. And then you have all the deductions that you have. I'm not sure of all the IRS deductions you can have for having investment properties in the US, but I know I built a very large house in a very nice suburb here in Melbourne, and I rented it off myself, and it was all tax deductible, right down to the knives and forks, that sort of stuff. So these are the sorts of things that rich people know and they do that other people don't do. Because to me, if I'm borrowing money, unless it's tax deductible, why am I borrowing the money? I have to really, really question it. And that's why I call it bad debt. And I know a lot of property people don't like me saying that a property that you live in is bad debt, because I'm for investing in real estate, no problems at all. But if I can't offset those costs of the interest and other things onto my tax or something else, or write them off or depreciate them, then it starts to lose its attractiveness. And because then I'm buying a lifestyle, because you live where you want to live, whereas I can actually move anytime I like. If I'm renting a property, I can move to any place I like. And a lot of young people, they want to live in these nice suburbs, but they can't afford to buy in those nice suburbs. So they tend to buy on outer suburbs where they don't really want to live because they can afford to live there. So it's better to buy an investment property and then rent in a suburb where you are happier to live, or you do want to live for that lifestyle. And what happens is with the rental properties or your investment properties, you're fine, and they're making far more money. And it's actually worked out you'll actually make far more money by buying investment properties and renting most of your life than actually buying a property to live in for your life. It's quite an interesting study.
Interesting. I'm going to have to study more on that one, because I'm happier owning the place that I live in. It's that simple.
Yeah, that's the shift a lot of people have got to have. It's a mental shift of not owning.
It is.
Yeah, it's a big mental shift.
I'm not going to go dig in the dirt and plant flowers in your garden, so let's move on. We're already approaching the end of our time here. We need to talk about stock splits. Two companies announced this week. First, why would I want to split a stock? Explain that. And what's the difference between a 2-to-1, 4-to-1, 5-to-1? the different ratios, please.
Yeah, Apple announced a couple of weeks ago that was doing a 4-to-1 stock split, and I think it's on next week. I think it's doing that. I can't remember the date. And last week, Tesla came out as well and said it announced a 5-for-1 stock split to occur at the end of the month on the 31st of August. Now, both of those stocks have traded higher since the announcement, but why do they actually do it? Well, Tesla's up at around $1,700, and what happens is people think stocks get too expensive. So what they do is they do a stock split. So in terms of Apple's stock split of 4-for-1, if you have one stock in Apple, they'll give you 3 more on the date. So then you'll have 4. But what actually happens with the price of the share, it's divided as what by 4. So therefore, it actually then starts trading at a much, much lower price, which then entices retail investors and others to get into the stock because they think it from Robinhood or whatever it is, and they go, wow, it's much cheaper, because the Robinhood investors will see Tesla at $1,700, and all of a sudden it's 5-for-1 stock split, and they'll see it down at a few $100s, and they go, wow, I'll get in that. It's really, really cheap. So that's why the company's actually doing it. It really does boost your turnover or turnover of stocks and the participation rate. But if you have a look at Berkshire Hathaway, their A shares, I don't think they've ever had a stock split. And you have a look at those. One of those would pay off your mortgage.
It's $180,000 a share or something like that, I think. Yes. Yeah.
So it's horses for courses, but generally the stocks are splitting. They do splits. If they're very big growth stocks, they continually split their stock to obviously balance it out in terms of how high the price is and what people generally think is too much to pay for one share. And I know a lot of people think buying cheap is buying a stock that's a couple of dollars. They're thinking they're getting a bargain because the stock is $1, where they're not, or $2, and they're not really, because you have to compare the price of the share to the value. Is Tesla valued at $1,700 or not? Is the intrinsic value of that company that high? And I would say no, it's not. I think it's overvalued at the moment. So by doing a stock split, they're bringing it down, but it's still overvalued at whatever the price is after the stock split, because it's about what's the intrinsic value of the underlying asset base and the revenue streams and the profits coming from Tesla. Apple, that's getting to that top end. As you said, the PE ratios are up over 20 now, and that's getting pretty high, and which tells you the market's getting top heavy at this point in time, and it's due for a pullback.
What do you see in the next week, Dale?
I'd say in 2 to 4 weeks up, probably 2 weeks up, maybe 3. I don't think we're going to go too much higher. Right now, we've had the highest close since early February on the Dow Jones, so I think it's going to go up for another 1 to 2 more weeks, maybe 4, and then come down into that fourth quarter. That's what I think is going to happen.
All right. Thanks for the update. We appreciate it as always. You can find more of Dale's great advice at wealthwithin.us. Also read his book. Dale, thank you so much for your time, and we will talk to you next week.
My pleasure, Jim. You take care.
All right. Good night, everybody. Take care. Bye-bye.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, as I said to Jim, last week was a little bit more positive for the Dow, and we've actually seen, as I said, I'm thinking we're starting to see a flight to a little bit more quality stocks rather than more speculation and getting into bubble stocks, if that makes sense, or more that technology sector. But that said, it's still all over the place, as Jim and I were discussing. There's stocks going up, there's stocks going down, there's strange things happening on the marketplace, and I don't think there's one expert or stock market expert out there across the US that I've looked at what they're talking about, and they're all saying they can't understand what's going on and why it's doing it. PE ratios are very, very high, which says eventually the proverbial's got to hit the fan, and when it does, then the downward move will start. But let's go and have a look at the chart of the Dow Jones. It's still the same chart that I've had normally. I've still left those arrows on that I've had here for over a month or more. Remember, my initial thoughts was if this was the high on that week there of the 12th of June, then what would happen is that we would actually get a bit of a secondary action, then a move down into low. The other one was we would actually move up into a high up around that 29 odd thousand points. We may even get up to that high back in February and break through that. It's possible. I'm thinking maybe, as I said to Jim, maybe 1 to 4 more weeks, probably more like 2, max 3 more weeks before we start moving down. I am expecting maybe a low into October. It may be a little bit early, maybe September, October or November. It could be in that area, but again, we will find a peak pretty soon. But at this point in time, it is looking a little bit more bearish here on me. Let me just put something on here. I just want to do this on here, and you can see that move there. So I'll give you a bit of a date here, and that one there. So probably somewhere around the end of, probably right through to about mid-October that could come in for looking at that time where I think that the Dow will actually fall away into. But again, expect this to a little bit vertical. But when you're looking at the market at this point in time, it's not about getting into it right now. Right now, when you're getting towards the peak of the market, it's always about slowing down and slowly exiting your positions if they tell you to. And it's not about exiting all your positions. What happens is you get ebbs and flows, and what happens, you might have 10 or 12 stocks in your portfolio, and you might find some of them slowly giving you exit signals if you use exit strategies such as stop losses and other types of exit strategies that traders or good investors will use, and you'll see a shrinking of your number of positions in your portfolio. So you may get down to 5 or 6 or 7 stocks or 3 stocks, depending on the positions that you hold. The market will eventually pull over and start to drop, and you're already exiting some of those stocks. But there might be stocks that you'll keep even with the pullback happening. You might keep a third of your portfolio. You may even keep 50% of your portfolio as the market's dropping, and then you're ready to get into stocks as it bottoms out and starts to come back up again. So don't necessarily just exit stocks. But the thing is I want to share with you is don't necessarily get in at the top either, because getting in the top means you could be just riding that last little bit before it falls away again. So you need to be careful about that. If you are in the market, make sure you do have an exit strategy. It will protect that downside risk. Make sure you capture your profits and don't suffer lots of losses. So, but at this point in time, it is looking bullish for the next 1, maybe to 2, 3 weeks at this point in time. I don't see it going more than 4 weeks up. But hey, right now, the market's not doing things that I would think are pretty normal. But anyway, let's move on to our questions for today. Now, our first question today is from Stephen, who says, "Hi, Dale. Always good to have your insights about the market. I'm from Melbourne and have been watching your Australia and US report every single week. I have a question on stock splits. What do you think about the recent announcement by Apple and Tesla on stock split? To me, it seems like these tech giants are trying to attract more of the smaller retail investors. Do you think this is the case?" Yeah, that's what I was talking about with Jim. Thanks for sending the question. It's always good because I did have a few people sending that question in, and I did have a nice chat with Jim about it earlier in this report. But again, it's a good sign. It's a positive sign that stocks are doing that. It's not. It does increase a little bit, but don't expect it to be more medium to longer term bullish. And this is really where I want to have a look at. I'm going to have a look at Apple and Tesla stock now to help you understand it. You might get a little short-term burst on the stock when they announce it, because people like announcements. You might get another little burst once they do the stock split. Obviously, Tesla's at the 31st of August. Apple, I think, is the week earlier. I think it's on next week. I can't remember, but you'll be able to find that on their website. I just forgotten the date, as I mentioned to Jim, but you might get a little burst for a little bit off when they do the stock split, but don't expect this to be a long-term thing at this point in time. Right now, it's not the time to get into either Apple or Tesla if they're not telling you to do so. Now, you can see here's your Apple shares on the screen here. It's just gone vertical the last couple of weeks, and it is beautiful stock, but it is very, very vertical. And if I put my little trendline tool on here, and you can see the actual angle of this, if I go backwards now, you'll see the angle that this is pretty steep. If I can drag it off, yeah, where are we? Give me a point on it. You can see how shallow this one is compared to that one. See how shallow that one is. There's a lot of moves. This is a really, really steep move, and you always get the steepest moves at the end of a run, and a lot of investors don't understand that. This is the steepest move this stock has had. We're going back to 2015, steeper than all of these moves. And so what you need to be very, very careful of is stocks that go up fast will start to come down fast. Now, whilst I'm not saying Apple's going down up fast. It's going up faster than it normally does, which means there's a lot of money moving in and speculating. And what happens then is it starts to tip over, or a stock will start to tip over. So my expectation, if we go back and look at Apple, is I think this will run out of steam very, very soon and start to pull back. Now, how far it pulls back will depend on how far it rises at this point in time. Again, all of these pricing here will change. And if you're looking at this on the stock split, so we're looking at it closed at $459 last Friday. So if it's doing a 4 for 1, so you're going to look at, it's going to be around $100 a share-ish when it does do the stock split. So, and you'll see all of these pricings change, and that really does cause not confusion for retail investors, but they go, wow, Apple's really cheap. I thought it was X. But they don't. A lot of retail investors don't really look at charts too much to understand where it's gone. But you'll see my chart after the stock split, it'll change pretty quickly. It'll be adjusted for that stock split. So what happens with charting packages like that, it'll recalculate all the data back to the start of data of Apple and readjust it for a stock split. So I can actually go into my software and actually put the stock splits, take them out and show you the chart where it gaps around and etc. But it doesn't make good analysis. But at this point in time, Apple's trading up very, very high there. I'm going looking at Tesla, and again, looking at Tesla, it's the same sort of thing. It's gone very, very vertical. I don't need to show you my trend line because it's just vertical there. It's pretty much the same back up here before it actually ran down into that March low, but that was only like a couple of weeks it took off. Here's a very big sustained move at this point in time, and you're seeing a lot of volume coming into this stock. You see the volume all the way through here is a lot higher than what it was earlier in 2018 and 2019. The volumes here are much higher. So I would expect Tesla will probably go through that $1,800 before it does its stock split. So that's another 2 weeks. It'll probably be doing that, but I think that'll probably be the end of it. I don't think it'll be sustainable at these sorts of levels. Again, I think Tesla is overvalued at this point in time. A couple of the other companies I wanted to chat about was Salesforce. It was one of the ones in my report that I said has done really, really well. You can see how normal this big trend is. It's just beautifully trending up quite nicely. Very, very orderly, not a big shooting up. It's not going that what they call rampant speculation going vertical here. It's got a 1 week down, but I do like this stock. I think it's a very short term come down a little bit, but I do like this stock. I think it's going to go further because Salesforce is a customer relationship sales marketing system for businesses, and I think there's going to be a lot of businesses using this sort of software moving forward from there. But let's go into PayPal. PayPal's another one that's been used a hell of a lot since COVID-19 meltdown. You can see this is a big move, very strong move. That one, I put this in the same basket as I would put Tesla and Apple. It's gone up very, very strongly, but too strongly, and it will come down because if I draw my trend line on that trend, you can see it hasn't done that ever in its whole history back since in 2015. Whilst that's only 5 years of data, where what we're seeing here is the stock is going up into more of a bubble type of situation where it's going steeper and steeper and steeper, and eventually anything that goes steeper and steeper and steeper must fall over. Think of a roller coaster ride. The steepest bit is just before the top, and then it just starts to tip over again. So that's what you need to think about when looking at it. But thanks for sending your questions in, and thanks for watching till the end of this video. Now, if you do have any questions that you'd like me to answer, just stick them below and I'll answer them. So remember, I do these reports every single week on a Monday, so hit the subscribe button now, click the bell on the right of it so that you know when we go live with our latest stock market reports. If you are an Australian, please don't put Aussie stocks on this one. Go to the Australian stock market report. But please, like this person with the question said that they were from where they were from, always tell me where you're from. I'd love to know where you're from around the world watching my reports. And again, if you've got questions, please do that. But for now, I'm Dow Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.